Thank you all very much for coming, and good afternoon, ladies and gentlemen. I'm Alex Pollock of AEI. It's my pleasure to welcome you to our conference today, Global Currency Wars, Endless Financial Crises, What's Wrong with the International Monetary System. We have a distinguished panel whom I'll introduce in a moment, but first I'll remind you of a little bit of history. By the late 1960s, the post-war Bretton Woods system, however carefully planned it was already coming apart. By 1965, Charles de Gaulle had publicly attacked the special role of the dollar, and France was turning in its dollars and saying, just give me the gold. Other countries were taking the gold as well, and looking back on it, this was obviously a highly profitable financial move for them to have made. Then, as we all know, with U.S. gold stocks declining and the dollar needing to be devalued, President Nixon unilaterally ended gold redemption in 1971 and therefore ended the Bretton Woods system. In August of 1971, Nixon went on national TV and said, quote, in the past 7 years, there has been an average of one international monetary crisis every year. In recent weeks, the speculators have been waging an all-out war on the American dollar. We must protect the dollar from attacks by the international money speculators. Accordingly, I've directed Treasury Secretary Connolly to suspend temporarily the convertibility of the dollar into gold. Of course, temporarily really meant permanently. And this launched us into a world which we now know and which we've gotten used to, of pure fiat currencies and floating exchange rates, the world of the last 4 decades. Thoughtful people in the 1960s could already see that such a world might arrive. And for example, there was a debate about it here at AEI in 1966, with Bob Rosa in favor of continued fixed exchange rates and Milton Friedman favoring moving to a floating exchange rate regime. Friedman argued that floating exchange rates would allow central banks to manage price level stability better and would engender stabilizing speculation. Now, we might wonder whether under the circumstances of the early 1970s there was any realistic alternative to moving to the present system, as we did. Whatever you think about that, we can observe that the 4 decades since then in question first saw a worldwide destructive inflation, and then a series of financial crises, one after another, right up to the continuing crises of the present day. In counterpoint to the general theme of floating exchange rates, we have, of course, the European project of a common currency, or absolutely, or in effect, effectively, absolutely fixed exchange rates, which has created, as we all know, its own dilemmas. So how should we understand this eventful history? What are the most important stresses now to focus on, and what, if anything, should be done? Our panelists have all the answers to these questions. So let me introduce our outstanding speakers. First will be Bob Aliber, who was from 1965 to 2004 professor of international economics and finance at the University of Chicago and is now professor emeritus. He was the Hublon Norman Fellow at the Bank of England in 1996, the J.P. Morgan Prize Fellow at the American Academy in Berlin in 2003, a visiting scholar at the Woodrow Wilson Center in Washington in 2004, a visiting scholar at the Federal Reserve Bank of San Francisco and consultant to the World Bank and Monetary Fund. His publications include the new International Money Game, now in its 7th edition, The Multinational Paradigm, and the 5th and 6th editions updating Kindleberger's classic discussion of financial cycles, manias, panics, and crashes. Our second speaker will be Ann Krueger, who is professor of international economics at the School for Advanced International Studies of Johns Hopkins University, a senior fellow of the Stanford Center for International Development, and the Harold L. and Carolyn Rich Emeritus Professor of Sciences and Humanities at Stanford University. Ann was the first deputy managing director of the International Monetary Fund from 2001 to 2006, and previously vice president economics and research at the World Bank. She is a past president of the American Economic Association, a senior research fellow of the National Bureau of Economic Research, and a member of the National Academy of Sciences, and has published extensively on economic development, international trade and finance, and economic policy reform. Then we'll hear from Desmond Lachman, who is a resident fellow at AEI. Desmond previously served as a managing director and chief emerging market economic strategist at Solomon Smith Barney, and was also deputy director in the International Monetary Fund's Policy Development and Review Department. He's written extensively on the global economic crisis, the U.S. housing market bust, the U.S. dollar, and the strains of the euro area, while focusing here at AEI on the global macroeconomy, global currency issues, and multilateral lending agencies. Desmond was an early and correct pessimist on the outcome of the European debt crisis, but he promised me that today he would bring a message of good cheer.
I was assuming you were short the euro.
Our last speaker will be John Makin, who is a resident scholar at AEI and a former consultant to the U.S. Treasury Department, the Congressional Budget Office, and the International Monetary Fund. John specializes in international finance and financial markets, including stocks, bonds, and currencies, and researches the U.S. economy, monetary policy, tax and budget issues, as well as the Japanese and European economies. He's the author of numerous books and articles on financial, monetary, and fiscal policy, including The Global Debt Crisis. That was the 1980s global debt crisis, ladies and gentlemen. And John also writes AEI's insightful monthly economic outlook letter. Each of our speakers will talk for from 12 to 15 minutes. We'll give them a chance briefly to respond to each other or clarify points if they wish, and we'll then open the floor to your questions. We will adjourn promptly at 4 o'clock unless you all run out of questions sooner than that. That said, Bob, you have the floor.
Thank you. Thank you, Alex. It's fun to be back in Washington. It's a marvelous city, and thank you for organizing this panel with distinguished friends. Let me speak briefly about my outline for the day. I want to talk about the debate that occurred presumably in this building in 1966. I then want to talk about the monetary constitution for floating exchange rates. These are the claims made to us by Milton and Harry and Fritz and Gottfried and others, their promises on how the system of floating exchange rates would behave. I then want to give you a stylized history of the 4 waves of financial crises since the early 1980s. After we review the 4 waves of financial crises, we'll be in a position to evaluate the claims made in this room about the merits of floating exchange rates. Then I want to go to what I would call the source of the shocks. And finally, we'll conclude with observations. What were the assumptions made by Milton and Harry and Fritz, Gottfried? What were the assumptions they made that have not been validated? Obviously, all Nobel laureates, very bright, heads of the AEA, but they got it wrong. So here's the debate book I encourage you all to read it. I haven't quite worked out the sequence of what happened when in 1966. The book is in 3 parts. The first part, a paper by Milton, followed by a paper by Bob. Then the second part is a sort of the rebuttals, Bob to Milton, Milton to Bob. And the third part is a discussion that involved people on the floor, journalists and the like, including Fritz, Howard Piquet of the Library of Congress, etc. As in all debates, Milton won. Can't imagine Milton ever lost a debate. Now, let's look at the monetary constitution for floating rates. And here I'd make a distinction between what I would call the normative arguments and the positive arguments. The normative arguments, I think there are 2 normative arguments. The first is no distortions to trade flows at the border, from tariffs, overvaluation, undervaluation. This is our objective. The second objective is monetary independence. Each central bank should have the freedom to do what it wants to do. Now let me come to the positive arguments. The first is changes in exchange rates would be stable. The exchange market would feature stability. The second positive argument was the national currency areas would be insulated from each other. And that led to the third positive argument, which was that central banks would have monetary independence. So monetary independence is both a normative argument and a positive argument. The fourth positive argument was that there would be fewer financial crises. A fifth made by Milton was that there would be less uncertainty. A sixth, that there would be less reliance on tariffs and other, sounds odd, doesn't it? Lesser reliance on tariffs and non-tariff barriers at the border. And a sixth, that the exchange market would be more efficient in the sense that forward exchange rates would be more effective forecasts of spot rates on the dates that the forward rates mature. Let me come to the 5 stylized facts that characterize the period since the early 1970s. The first is that we've had 4 waves of financial crises. The first wave, John's book, the 1982 crises involving Mexico, Brazil, Argentina, and the other developing countries. The second wave of crises occurs in the early 1990s and involves Japan and at the same time 3 of the Nordic countries, Finland, Norway, and Sweden. The third wave of the financial crises is the only one that has a proper name, and that's the Asian financial crisis that begins in July of 1997. Though in retrospect, I would put the Mexican events of 1994, 1995 as really a precursor of the Asian crisis. And the fourth wave of financial crises begins in 2007, 2008, et cetera. Each of these waves involves 3, 4, more, sometimes 10 countries, either more or less at the same time or sequentially. Each of these waves of financial crises follows a credit binge, when the indebtedness of a group of borrowers grows at 20 to 30% a year for 3, 4, or more years. In some waves, these credit binges have involved credits to governments. This was characteristic of what happened in the 1970s. You remember the countries don't go bankrupt? Who said that?
Walter Wriston.
Walter Wriston, very good. And who said, you have to keep dancing as long as the music is playing?
His successor.
One of his successors. I mean, marvelous brackets for this period. So we've had credit binges. In Japan, the credit binge is domestic. It involves extension of credit for the real estate industry. The third wave of credit binges is much more variegated, but money flows to Mexico involving direct investment, portfolio investment, money market investment, etc. That's characteristic of what was happening in South Korea and Thailand, etc. Differences among these countries. And the fourth wave of credit binges is what I would loosely call the Anglo-Saxon countries, though we could put the members of some of the members of the European monetary zone, etc. Each of these, three of these waves have involved sharp increases in asset prices. The first wave did not, and that's because the supply of government debt was increasing about as rapidly as the demand for government debt. But in the subsequent three waves, the asset prices in countries increased very, very sharply. My favorite small country is Iceland. Property prices doubled. Stock prices increased by a factor of 7 or 8. These waves, my fourth stylized fact, is that these waves generally have been associated with cross-border money flows. The first wave, as I mentioned earlier, involved loans to Mexico, Brazil, Argentina, and the like. The wave, the credit binge in the Nordic countries involved cross-border money flows. The cross-border money flows and their role in the Japanese credit binge are very complicated. We're happy to deal with it in terms of question, but I won't use up time at this moment to speak to that issue. The third wave of credit binges involved cross-money flows, and in each of these cases, we get very large real appreciations of the currencies of the countries affected. And in the fourth wave of credit binges, we involve cross-border money flows. In the U.S., a non-significant part of the housing bubble, the real estate bubble between 2002 and 2008 can be traced to the inflow of foreign money, which led to a conundrum, low interest rates, real estate prices increased. And if you want a brief interpretation, essentially the inflow of private saving was displacing domestic savings, and the mechanism was asset prices were increasing. Now, those are the, and the fifth stylized fact is that during this period, the firms that trade, the investment banks, the commercial banks, the hedge funds, Caxton, the firms that trade currencies have done fabulously well. High rates of return on capital. The rate of increase in revenues is many, many times larger than the increase in the volume of trade, which leads to a very interesting question. It seems almost like a victimless crime, but what is the source of the revenues? Who's paying, if you want? Now let me come to my evaluation. How well the arguments of the proponents look in retrospect. Well, the deviations, the overvaluations have been many times larger than what we were promised. When we had overvaluations under the pegged rate system, it was because we had differentials in domestic inflation rates. Here, the overvaluations are associated with the currency movement. And I'll illustrate that in the Mexican case, or I could do it with the Icelandic case, but most of these cases are the same. You get a surge in the flow of money to a country, and the surge in the flow of money to the country leads to an increase in the value of its currency. The second thing that is happening when you get a surge in the flow of money to a country is that asset prices increase. I've written extensively about this. This is I've been inspired by Keynes's analysis of the transfer problem. But if you have an autonomous increase in the foreign demand for Icelandic securities, Iceland has to develop a current account deficit, an induced current account deficit that is the counterpart of the autonomous increase in its capital account surplus. And the mechanism is an increase in asset prices. That's an integral part of the adjustment process in all of these cases. So let me, we've had more, I would say more waves of crises despite the 7 crises. And the uniqueness of these crises is that by and large, banking crises have been associated with currency crises. In some cases, we've had banking crises not associated with currency crises, although the banking crisis was attributable to a decline in money flows to these countries. So let me illustrate this in terms of the cash flows. In all of these cases, the external indebtedness of these countries, or in the Japanese case, the domestic indebtedness is increasing at 20 or 30% a year. The interest rate, I'll say, is 6% a year. That's Ponzi finance. And so once we begin to see that the indebtedness of these countries is increasing at 20 or 30% a year, we can predict that there will be a financial crisis. We may not be able to identify when it will occur, but it is inevitable in terms of the imbalances in cash flows. So let me come now to the concluding part of my remarks. What did Milton, Harry, Godfrey, our friends, teachers, colleagues, what did they miss? Why did they get it so wrong? So very wrong. And I would say there were 2 things. The first thing was they had a very simple model. It was a model in which there were 2 groups of participants in the currency market, goods market traders and speculators were largely like market makers or specialists in financial institutions. Their models did not permit long-term capital flows. The second thing they missed, and this is a real puzzle, it's a real intellectual puzzle. The second thing they missed is that the shocks would be primarily monetary. They believed the shocks would be primarily structural, increases in oil price, bad harvests, and the likes. But the shocks that have led to this great instability have been monetary shocks, increase in cross-border flows of money at a non-sustainable base. And that's really a great puzzle in the sense that they wanted monetary independence. They should have anticipated that the exercise of monetary independence would have led to cross-border money flows, and they should have asked the question, how long will these cross-border money flows be sustainable? Thank you very much. I look forward to challenging questions.
Thank you, Bob. Ann.
Thank you. I want to start in a different place and I'll end up in a different one too, because I think one thing we need to remember whenever discussing this set of issues is that a well-functioning financial system is crucial within countries for growth, and it needs to be well-functioning in allocating and save resources to the risk-adjusted rates of return on alternative investments. It does need regulation, but regulation has to be such that indeed the flow of funds goes where it is most useful, and given, as I said, the risk-reward risk-adjusted ratings, and this is often forgotten in the discussion. The financial system has had to evolve along with the real economy and has done so for centuries, not for tens of years, not for 50 years, but for several hundreds of years. I always like to remind people that, for example, the Rothschilds' real wealth began when they figured out that they could send carrier pigeons from Brussels to London, and they could get the news there 4 hours faster. But all kinds of financial innovation, including carrier pigeons, and of course later on using the telegraph and the internet, have been crucial to the diversification and to getting a well-functioning financial system, including not only money but equities, including angel financing, including all kinds of finance that you think of, having an insurance sector, and so on and so forth. We need to intermediate between savers and investors, and risk appetites differ between people and desires, and for all those reasons you have to have it. In the good old or the bad old days, 5 or 6 centuries ago, most finance was family finance. And you could have 2 families, one of whom I suppose had a baking business, very high rate of return, but they could expand only as their profits enabled them to do so. Another family had a very lousy business as they were busy doing street cleaning or something like that, and their rate of return was very small, but they had no place else to put it. Think how much you do by enabling savings to go where it has the most productive use, and we don't want to forget that as we discuss the financial system. With the increasing complexity of the economy, the financial system definitely has evolved, but there have always been crises, and in a way, it's inevitable. And there's a wonderful book by Carmen Reinhardt and Ken Rogoff, which is called "This Time is Different," meaning it won't be the first crisis of the 21st century, because there have always been financial crises. Finance is about taking funds now and using them for something in the future. The future is inherently uncertain. There are bound to be surprises, and the question is how to make sure that you get the flow of funds to a degree that's desirable, socially optimal, and at the same time don't have more crisis than you need to have. One argument about the housing bubble in the last decade and before that is housing prices have been rising pretty much for 50 years. You can't have such a steady progression without people finally figuring or thinking they'll figure out that it lasts forever. And when they figure that out, things are going to go wrong because it can't last forever and it will bust. And I suspect that it's stupid to try and say we'll get rid of the phenomenon. What you can do is find ways to get better regulation. We can do a lot of that. And you can find ways to make the financial system work better. But to say that we're going to have this perfect system so we never have another crisis, I think is probably wishful thinking. Crises can be more or less severe. They can be buffered in various ways. There can be policies adopted in response to crisis that make things much worse. And, of course, you can throw the baby out with the bathwater and you can have a stagnant economy and no financial crises. That is possible. Myanmar has had no economic growth in 50 years, but they've also had no financial crises. This is not the model that you want. Okay. And poor reforms can set things back. India in the 1970s crisis nationalized all its banks. It was a big setback. So I just want to make clear that when we say we want more of this or more of that, we have to specify what. It's not enough to say things aren't good. You got to say how you could make them better. Okay, I don't have much time, so what needs to be done? First, I'm going to focus on the international monetary system, not the domestic, although it spills over a bit, of course. And I do think that there are so many issues where they are international that some kind of strengthening of the international system is desperately called for. In any number of ways. One thing that's going to take, that I'll take no time on at all, is getting a monetary system where the voice or the weight or whatever you want to call it of the individual countries participating in it better reflects their economic role in the system. That's coming, but it's very slow and it's not coming well, and something needs to be done. But going on to things that we can do more on the substantive side rather than the process side, there has to be the strength in the IMF and support for it by major countries. The U.S. was the hegemon. The U.S. had the most power. The U.S., I'm afraid, forgot its interest in the system as a whole and used that power for what it saw as the short-term national interest a few times too often. Other countries followed that lead. And there are now too many issues that are perceived to be way too important where interdependence matters for everybody. The U.S. has a role in the international system similar to Germany's role in the euro. Germany is the big hegemon there, and both have to take a viewpoint about the interests as a whole. So do other countries, too. I'm not saying they don't, but the U.S. bears a special responsibility. Clearly, regulation is important, but a lot of it has to be done internationally. Anybody that tries to raise capital requirements very much in the U.S. or the U.K. is immediately going to run into the argument, it is not a bad argument, that, well, if you raise them for us, you'll just be sending the banks to the other country, unless they raise them too. And there's a lot to this argument. It is not entirely self-seeking, although there's an element of that as well. We need to get more transparency in the system. We need to get markets for derivatives and other financial instruments rather than leaving them traded over the counter where indeed nobody knows what's going on. Transparency will not do it, but it would help, and it certainly cannot hurt for most of the financial transactions we're talking about. Higher capital requirements for banks, yes. We have not as yet in any of our countries addressed the too big to fail problem, which is real. And that's one that needs attention. Higher capital requirements for big banks, again, only if you do it across countries. If you do it in the United States, the big banks will, of course, go to another country. There has to be some way that these things are agreed internationally, and, of course, there's working in doing that. Contingent convertible capital, which would convert the minute banks need more equity. That's a possibility that has not as yet been tried, at least in the U.S., which would make sense. There are many other things. So let me move on from that issue. A big issue which certainly contributed to, in a very major way, the financial crisis of 2007 and following was global imbalances. The Chinese had a very large current account surplus, which the U.S. accommodated with a very large current account deficit. The way I think of it, each was an enabler of the others. They were mutually enabling. Had the Chinese not run such a, or wanted to run such a surplus, the Americans could not have run such a deficit, and vice versa. It took two to tango in that case. There aren't too many other pairs of countries where you could get the same kind of thing. The oil exporters as a group can and have played the role of the surplus country on occasion, and they contributed to the intensity of the imbalances in the middle of the last decade. But both sides did it. Now, the U.S. would have experienced more pressures, more inflationary pressures, and would have had to adjust. China would have had to shift to more domestic demand earlier. That would have been good for each country in turn. But with the U.S. determined to maintain its fiscal and savings stance, the Chinese theirs, that didn't happen. The IMF did not only point to the problem over and over again, and indeed proposed to try and fix it with something they called multilateral consultations. And if you think the IMF did not, go take a look at Raghu Rajan's speech in Jackson Hole in 2005, where he spelled it out, I think, quite eloquently, and basically got booed out of, almost out of the conference entirely. The financial community and the other people there were not willing to accept it. The IMF was one of the very lone voices. BIS was there too. There were a few others, but not very many. But in any event, mutual consultations were tried where the 5 or 6 major players were brought together. Eurozone countries, Japan, oil exporters, the U.S., UK, I think was one more. Anyway, when they were brought together, everybody agreed there was a problem. Everybody agreed the Chinese balances were unsustainable. The U.S. balances were unsustainable. The U.S. should cut its deficit and save more. The Chinese should expand domestic demand. What they did not agree on was who should do what. The Chinese thought the Americans should do it, and the Americans thought the Chinese should do it. So nothing happened. The IMF had no powers whatsoever. What's wrong with the international financial system? You can spot some of the macro imbalances 10 miles off, and there's not a thing that anybody has the power to do. And it can't be done at a national level. Now we have the G20 having recognized the global imbalances problem. They've instructed the IMF to do what they call a mutual assessment process, from which each G20 country submits its macroeconomic plans, and the IMF is supposed to announce on whether they're consistent or not. So far, it's been a purely mechanical exercise, and I know of not a single penny or shilling or euro or anything that has been changed in anybody's budget as a result of that exercise today. Everybody agrees on the problem. Nobody is willing to have the mechanism. And by the way, it's not all that different from the problems in the euro area now, where again, there's not a mechanism or a process or something that's enforceable that lets these imbalances be addressed. So in my judgment, that's a major problem of the international system, and that, plus getting coordinated agreement on some of the regulations that would govern and perhaps somewhat more constrict the financial sector, are two major issues that need addressing. I'm just looking at my time here and going very fast. We do need some kind, I think, very strongly, a sovereign debt restructuring mechanism. If Greece had been confronted with such a mechanism a year and a half or 2 years ago, the savings to Greece, to the euro, to the world would have been enormous. How you could do it, you could argue about, but that there's no, at the moment, there's nothing to do with, quote, voluntary. So the creditors and the debtors should meet. Well, agreement by committee is not necessarily always the way, and in most things we have arbitration, mediation, courts of law or something. But in the international system, much as we have law governing contracts and stuff, we have nothing by way of sovereign debt restructuring, and in my judgment is needed. But again, for lack of time, I'll stop there. There are a lot of other issues. Resolution of jointly owned banks and subsidiaries. You had a large Belgian, half Dutch bank fail, and it wasn't clear whose jurisdiction it came under. These issues become more important as banking becomes more international, and are going to have to be addressed, and some of them are being addressed relatively well. But there's, in all of these, a bigger call for something with some teeth internationally, much more so than we now have. I'll mention it only because everybody else does, and that's capital controls. And some people are saying that that's the way to handle things. I'm not sure how far you can go along the capital control route for a variety of reasons, but the most important one is I don't think you can do it without a major disruption of trade. Money is too fungible, it goes in too many directions, and in order to have meaningful capital controls on outflows in particular, you would really, I think, have to have inspections as to what the goods are, et cetera, and enforcement is incredibly difficult, and it causes at least delays in flows of goods and services and would be enormously disruptive of the system. If there's no need for capital controls, they work fine. When you need them is the only time when you have any trouble with them. Overall, I think much remains to be done. We made some progress. Right now, of course, the focus is on the euro area, and it's distracting, I think, the international community from but providing lessons. It's doing both. On the one hand, we are not making as much progress as we should on global imbalances, on changing regulation and those issues, but we are seeing the fixed exchange rate system having its own flaws, as it did earlier on, in a big way in the euro system. We're seeing what happens when there's a fixed exchange rate, and simultaneously there is not a regime governing the fiscal relations between the entities, and that's important. And I think it's a lesson that's useful for all countries. One thing I'm sure of, though, and that is that there will be another crisis after we get through the euro crisis and all that. It will be different yet again. We can do things now that will make that crisis less severe than it would otherwise be. But in that regard, there's no way we are going to prevent it, or there's no way we're going to prevent it that we would want to, because it would be so very costly. Thank you.
Thank you, Anne. Well, just as AEI was debating these things 45 years ago, we'll get to debate the next crisis much sooner than 45 years from now. Desmond.
Yeah, thank you, Alex, for arranging this conference, and I very much enjoyed the two presentations that precede me. What I thought I would do is I'd make a couple of general observations on how I see the monetary system, some of the reasons that things might need to change, and then the latter part, I'm going to be talking about two major challenges to the system, not simply the Eurozone, but rather the very high degree of leverage that we've got in the system right now that I think is going to put a lot of stress on the monetary system going forward, and it's not going to be easy to deal with. Just in terms of the general remarks, the first remark I'd like to make is when we have these kind of discussions talking about what the faults are of the floating exchange rate system, and maybe we should go to a fixed exchange rate system in return, it reminds me of Dennis Robinson, who was a famous Cambridge professor, used to say about economic fashion in economic ideas, it was like going to the greyhound races. If you stayed still long enough, the dogs would come around another time. And I was just wondering whether Bob was really wanting the dogs of the fixed exchange rates to come around another time. I view matters rather differently. I don't view the problem as being so much the floating exchange rate, that the exchange rate flexibility as being the underlying cause of the magnitude of the crisis that we have. It's rather, I think Anne was touching on that it's rather the idea that we've moved to a system of completely free trade coupled with total liberalization on capital markets. I think that once you've got that case, it's the total liberalization on the capital market side that propagates these crises and made them of this kind of magnitude. And I would say that you don't have an alternative, as we learned in the Asian crisis when we talked about the impossible trinity. You couldn't have fixed exchange rates, free capital markets, and monetary policy independence. Those three don't coexist. If you want one, if you want two, you've got to give up on the other. And I think that if we do move to a system where we've got completely free trade and if we move to where we've got free trade and open capital movements, then we have to have flexible exchange rates, and we've got to learn to live with it. I'm not sure that I agree that a lot of these crises were inevitable, even within a floating exchange rate. If I think of the United States housing market, I think that macro-prudential policy, raising loan-to-value ratios or cracking down on non-bank mortgage originators, you could have limited. It was not inevitable that you had to have a crisis of that magnitude, and I'd say the same thing within Europe. A lot of policy mistakes get made. So my short take is that the Bretton Woods system that we had from 1945 to 1971 was a reaction to what occurred during the post-war period, the total collapse, the beggar-thy-neighbor policies, the exchange rate depreciations. So you went to a fixed exchange rate, but that worked well because it was done largely in a system where trade wasn't particularly open, at least in the initial period, and where you had capital restrictions. When you opened up, then the system came under attack, and there's no way that you can go back to that system if you want to have totally free trade and you want to have open capital movements. A second point that I just want to make is that we perhaps talk a little bit too much about exchange rate movements rather than the issue of the underlying imbalances. That when we look at imbalances on an external side, they are generally the product of disequilibrium between saving and investment behavior. And I think too much of the focus is on, is China manipulating its exchange rate? Are they keeping things too depreciated? Rather than, are they under consuming? Are we under investing? That sort of thing that you have to talk about the imbalances. And I think that that's really where the coordination occurs. And I've got some sympathy for the idea that Guido proposed, that you should basically be targeting current account balances and figuring out what is the macroeconomic policies that are consistent with that, rather than have the whole discussion revolve solely around the exchange rate. Having made the general points, that was the very optimistic part of the presentation. Now to come to the challenges that I see. The two challenges, that are encapsulated in this first chart, which just indicates, the levels of public debt in relation to GDP. And what you can see is we're really going to levels that we haven't had before. Certainly Japan is in the stratosphere, that its public debt is just way too high. The United States and even Europe is on a path where we're going to be at the levels we were in the late 20s that led to all of those problems. The way in which I see it from the exchange rate point of view is we really have a problem now. If all countries are deleveraging at the same time, you've got a problem as to where the demand is going to come from, and that is really going to be a huge challenge. This is really the origin of the currency wars right now. Everybody sees the problem that the private sector is deleveraging, that the public sector's got too much debt, that they've got to go on fiscal consolidation. Well, obviously the solution is we're all going to export our way out of the problem, and that really doesn't work, and that gives rise to the complaints against the quantitative easing that we had in the United States, the United Kingdom, and so on, that you're getting from the Brazilians. Just parenthetically, I like this chart, which explains some of the problems that you do have in the emerging markets. What this chart is doing is it's taking a chart that Bill Gross made famous sometime last year called the Ring of Fire chart, that the first circle is the industrialized countries, and on the one axis is the level of public debt to GDP. On the other axis is the budget deficits, and you see that the industrialized countries are all in the wrong quadrant, that they've all got not all, but certainly the United States, the United Kingdom, Italy, Spain, Japan, big countries have got very high levels of public debt, very large budget deficits, and means that they've really got to do the consolidation. Where on the emerging market side, you see that those countries, whereas the industrialized countries have got public debt to GDP ratios of around about 100%. These countries are more in the 40-50% of GDP range, and likewise their budget deficit. Now, I think that the real crisis that is still coming, despite what the ECB has done with the LTRO program, despite the calm that we've got in the markets, I'm always impressed with what 489 billion euros can do. That it's really just brought us a temporary respite. And the reason I say that, well, first, this chart just gives you the order of the magnitude of what is at stake. That, aside from Europe being a third of the global economy, this chart is just telling you the amount of sovereign debt that is floating around there. For instance, the Italians alone have something like $2 trillion of sovereign debt, and if you add up Spain, Greece, Portugal, Ireland, throw in Belgium, you're talking about 4.5 trillion euros of debt. So if this thing doesn't work out, you've got a real problem for the European banking system, for the global financial system, and you'd have an unraveling of a currency arrangement for the biggest economic bloc on earth. That is really going to be the challenge that we're going to have to live with. I fear that globalization might be at risk. Just very briefly, the reason that I think that this thing can't possibly work is that you've developed two very large imbalances within a fixed exchange rate system. The first is on the current account side, and I think that this chart is instructive. Within a fixed exchange rate system, didn't prevent countries like Greece and Portugal and Spain at one point, running current account deficits of around about 10% of GDP. Germany on the other side having a current account surplus of something like 6 or 7% of GDP. But that is the one big imbalance that you've got. And of course, what gave rise to that is even with a fixed exchange rate system, you had enormous losses in competitiveness. That the islands, Greece's, Italy's, in relation to Germany, lost something like 15-20% competitiveness. Not a good idea in a fixed exchange rate system, because what that means is you've got to engage in what's euphemistically in Europe called an internal devaluation, another word for wages and prices falling for a protracted period of time. But what that does is it then compounds your other problem, which is a public finance problem, budget deficits, which are 10% of GDP or more, and public debt to GDP ratios that in the case of countries like Greece are 160%, or even countries like Portugal or Ireland, really over above 100%. If you get the internal devaluation through price deflation, it compounds the public deficit problem. Now, to deal with the public deficit problem in a fixed exchange rate system, what you've got to do is you've just got to engage in fiscal austerity, 2 or 3 percentage points of GDP, not for 1 year, not for 2 years, but for 3 years. And my view is that this is really just going to be producing deep recessions. When you get the recessions, you're not going to collect the taxes. When you don't collect the taxes, you're going to have another round of fiscal tightening. You're going to get a political backlash. So I really don't see how this euro crisis plays out. What we're already seeing, what deepens my pessimism is that what we've got the countries in the core, we've got France and Germany now, which were growing at something like 3% at the beginning, the last year or two. They now actually moving into recession. The latest numbers on Germany, negative growth in the fourth quarter. So what you've got to do is you've got to engage in fiscal contraction, not only when your economy is in recession, but when your external environment is going sour. And to make matters even worse, this chart just tells you what is happening to the European banking system. Because of the losses on their loans, what is occurring is there's a credit crunch going on. So I tell people that my alma mater is going to get my diploma back if we don't have a big recession, because maybe Keynes had too much influence on Cambridge, where I studied. But he did indicate, that if you were tightening the budget, having effective monetary policy tightening, having a bad environment, having some countries to deal with housing busts, and you don't go into deep recessions, that would really be amazing. And I think that once you go into those recessions, you can throw as much money as you like at it. All you're going to be doing is kicking the can forward. So I think that this is really going to be the big story, and how it works out, what sort of monetary system we get after that depends how this crisis plays out. But Alex might be surprised, as I haven't changed my mind, that this is going to end in tears.
Mm-hmm.
Thanks, Desmond. John.
Well, great review of exchange rate regime issues, and my basic point is going to be that in terms of views of exchange rates and needs to adjust to international disequilibria, the international monetary system today is probably doing better than it has in the past. Let me try to support that with a few historical examples. The basic principle is clear, and Des has referred to it. That is, if you want to peg your exchange rate and capital flows freely, then you've got to be passive about what happens to your money supply. Because you can't. If we had a big blackboard, you could write down a general equilibrium system, and either the currency price is endogenous or the quantity of money is endogenous. There is a quantity of money that will clear the markets if you peg some exchange rate. It's just that most countries, when pegging an exchange rate, don't think about that, and the quantity of money that would work isn't one that's very attractive, and that's become particularly clear in Europe, as Des has pointed out. But I think that's the basic reality. Now, there are two eras, really, with respect to exchange rates and the international financial system. Probably more eras, but I'll just think about two. First was the era of the sanctity of fixed exchange rates, and this was the debate that Milton Friedman and Bob Rosa were having, was during the period of fixed exchange rates. We've got to have them. The world will come to an end without them. I remember that doctrine very well, working at the U.S. Treasury in the early 70s. Before the August events, it was like, don't even think about floating rates. The world will come to an end if rates were allowed to float freely. Now this, an early episode of this was 1926. Bob knows well, the British insisted on pegging sterling at an overvalued level. They wanted to peg sterling to gold because sterling had been beaten up during and after the war. They wanted sterling to go back to gold to anchor a solid international financial system. Now, the trouble with pegging an exchange rate is nobody knows what the equilibrium exchange rate is. So if you peg it at a level that overvalues the currency, you will see outflows, deflationary pressure, downward pressure on wages, and rises in unemployment, which is exactly what the British saw. And this precipitated the problems that led up to the Great Depression. And what's odd is that people took the lesson of the Great Depression to be one that you should have fixed exchange rates, when actually you could argue that it was precipitated in no small part by an insistence in the UK and reactions of others to pegged exchange rates. But leave that, be that as it may. Now the post-World War II Bretton Woods system was the sanctity of the fixed exchange rate. It was called the dollar exchange standard. The dollar was pegged to gold. Everything else was pegged to the dollar, so they were all pegged to gold. And we were going to have a system that was essentially gold-based, and that was going to be a stable system. The big worry, as the economic historians here know, is right after the war, there was the fear that the U.S. would be a chronic surplus country. The IMF tried to include a scarce currency clause in its original agreement so that the U.S. would be forced to adjust if it was accumulating too much in the way of reserves as a chronic surplus country. The U.S. Vetoed that idea because, understandably, they did not want their policies to be set by the requisite level of policies in the U.S. that would mean external equilibrium. This story, it comes up again and again. External equilibrium is not something that is taken seriously in an operational sense. And fixing exchange rates means a problem there. I should have mentioned one other episode in 1967 when sterling had to be devalued as well. That was another case of the classic currency crisis. The British saying we'll never devalue. Of course, they devalue because once they say they won't devalue, the speculators get hold of it, and they do devalue. Now, I think what I would argue that what cured the world of, not altogether, but the Asian crisis in the late 90s, which was characterized, first of all, by there were big inflows into Asia, and then they were overdone, and then the problem, it wasn't sustainable. Indonesia had to borrow 6 months, 3 months, overnight, and so on. And you had a big preference, and I think this is fair, that the IMF was anxious to see exchange rate stability preserved. Having talked this over with Stan Fisher, and in any case, that didn't work out very well. That eventually it was decided that you had to let those exchange rates adjust. So the issue, about today's currency system, I think, is better than the currency system of the post-war period because I don't see out there a strong feeling that exchange rates must remain fixed because there's so much capital mobility that it's virtually impossible, and countries are surviving perfectly well with floating exchange rates. There were all kinds of huge literature on if exchange rates are floating, there'll be so much exchange rate uncertainty that trade flows will be penalized, blah, 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 blah. Didn't happen. It's not the end of the world. And now you put into this world where you have a lot of capital mobility an odd event. Europe decides that what Europe needs is a single currency area. That is, they need to have absolutely fixed exchange rates between Germany, Greece, Italy, Spain, and so on. And the idea is that this has to happen because it's necessary for European stability. And of course, you impose a monetary union, which doesn't satisfy the conditions of an optimal currency area. You need a lot of mobility of resources, a transfer mechanism, and or you need to have high level of mobility of labor. Europe really didn't satisfy those conditions. But it was necessary to get going on the project, so you establish a monetary union without a fiscal union, and that discussion has been carried on in the past 2 years about how that's not going to work. Now, how did this lead to a problem? Because in a sense, you're pegging exchange rates. Okay, so that means that if you've pegged exchange rates, let's just say between Germany and Italy, to take a case in point, then Germany ought to be passive about its money supply. But it's all the same money. And so what's happening is that Germany is in a situation where, in effect, the exchange rate that they're facing implies that their currency, which is the euro, is overvalued for them and perhaps undervalued for Germany. And so at the same time, that leads to capital flows. And the European Central Bank says to anybody who wants to borrow money in Italy, that's fine. You can borrow money. The bonds that are created when you borrow money will be treated as if they were perfect substitutes for German-issued bonds. And essentially, you can keep borrowing. And then the BIS says, well, no, I'm sorry, it's the BIS rating system says that sovereign debt doesn't have to be, you don't have to reserve against it. So in a sense, the European monetary system was a huge gift to countries that needed to borrow to sustain their living standards and would otherwise, in a real currency system with fixed exchange rates, would have experienced large outflows of liquidity and sharp contractions that would lower wages and prices such as we see is needed today. So you have this, what is odd to me about the European monetary system is that after perhaps decades when it became clear that it's very difficult to engineer a fixed exchange rate system, and we knew the criteria for optimal currency areas, that Europe would step ahead and say, well, there's a political imperative that we have to fix exchange rates among these countries. And I guess the idea was that the discipline of the fixed exchange rate would force adjustments of prices and wages and living standards in countries in Southern Europe. Actually, the reverse occurred because of the way the system was structured. That is, again, you could borrow Greece, Italy, Spain, issue bonds. The banks buy the bonds. The bonds can be repoed. That is, you can use them for collateral at the European Central Bank, just as if they were bonds that were issued by German companies and German institutions. And so, why not borrow? And of course they did. And then what we see now is that there's a huge incipient exchange rate disequilibrium. It's incipient because we have the same currency, and that translates into, okay, it's a currency peg, but there's a huge incipient need for deflation in Southern Europe. And instead of allowing prices to adjust, we step in and say, well, you're going to have to raise taxes and cut spending. And in some of the countries like Greece that don't have an effective mechanism for effecting fiscal policy, that is for collecting taxes in other words, it just doesn't work. So now what we're seeing is the need for transfers from the rest of Europe to Greece keeps going up. We're just in the middle of a negotiation for 130 billion euros now, and the quid pro quo is that Greece pursue further fiscal stringency by raising taxes and cutting spending as a substitute for adjustments of wages and prices that isn't going to occur. The problem with that, of course, is that to the extent that other countries are doing it, there's a fallacy of composition problem. It's essentially contractionary, and what we saw, you could predict, if you write down the equation for the determinants of debt to GDP, you could predict in 2009 that several years later, if you impose strict fiscal stringency on Greece, if prices and wages didn't adjust, which of course they weren't going to, that you would see a higher debt to GDP ratio 2 years later because GDP was going to contract and debt was going to continue to rise, but the contraction in GDP would be so much that the debt to GDP ratio would actually rise, and has done. And then it's dynamically unstable because as this begins to happen, the interest rate, nominal interest rate rises to relative to nominal GDP growth, and the problem is exacerbated, and so you're stuck. So where do we come out on all this? Well, with the exception of the European monetary system, which is a very problematic setup, and the problems are well recognized, but the politics haven't allowed for an adjustment. I would say the rest of the world has become somewhat ad hoc, somewhat, how shall I say, adjusting as needed when it comes to currency systems. The other big issue is the U.S. and China. China chooses to peg its exchange rate with the dollar at a level below equilibrium, and very predictably they get inflows and incipient inflation pressure, which they try to sterilize, and then they're left to have to invest the reserves they accumulate elsewhere. So this keeps the system at a sustainable level. But there again, if the byproduct is clear, if China chooses to peg its currency at a disequilibrium level, that is one that would imply non-zero flows between China and the rest of the world, they'll experience the symptoms that they're experiencing and a need to accumulate claims on the rest of the world. So while there are spots out there, I don't think as Desmond was speaking, I was trying to figure out, is there a way we could blame the housing crisis on the currency regime? It's a bit of a stretch. We can certainly blame the sovereign debt crisis in Europe, I think, on the currency regime there. And the periodic financial crises we saw from before the war and afterward that Bob went through were largely attributable to an insistence on a pegged currency that was really not an equilibrium currency, and then refusing to obey the rules. Again, the Bretton Woods, just one last thing, the Bretton Woods system broke down because, as Robert Triffin pointed out, if the U.S. doesn't really have an external a constraint, an exchange, a balance of payments constraint, and the rest of the world wants gold, the implication will be incipient and actual inflation pressure in the U.S. that will render the peg between the dollar and gold unworkable. And in August of 1971, President Nixon simply announced that that's right, it's unworkable, and we're ending it. And as Alex suggested, it was taken to be temporary, but it's not. So the bottom line is, if you want to control your monetary policy, then don't peg your exchange rate. And if you do peg your exchange rate, be ready for some problems that you'll have to deal with either through monetary and fiscal policy or currency crises.
Thank you, John. And thank you all for a really interesting set of presentations. And from the point of view of the chair, thank you all for your superb discipline on time, without even a reminder, every speaker. I just want to say one thing, one element in all of these problems is, of course, credit. And I always think of the thought that debt is the snake in the economics garden of Eden. And it's the temporary buildup of debt, as Bob was suggesting, sometimes at rates extremely fast buildup of debt that all leads us to the situation that Max Winkler wrote about in a 1933 book called Foreign Bonds and Autopsy, with the bondholder gazing sadly, he said, at the promises to pay, which he obviously was not going to collect, at least not collect at par. Let me give the panelists each, let's say, up to 2 minutes. Each will just go down the panel to respond or add any thoughts that you want. Bob?
Thank you. I would make 2 observations. We're talking about 2 different exchange rate regimes, and I think that's really unfortunate. We're talking about events within Europe, a peg rate system or a fixed rate system, and we're talking about whether floating exchange rates have lived up to their promises. And there so I want to focus on the second, the promises that were made in this room. And I will speak to the last point of John Makin's. What is the explanation? What is the explanation that John has for these credit binges that we have observed in the Nordic countries, in the Asian countries, in the Latin countries, and in the Anglo-Saxon countries? And here I would speak to, in part, the comment that Anne made about the Americans and the Chinese have enabled each other. We would not have had a very large trade deficit if they had not insisted on maintaining very high levels of protection and very low levels for the value of their currency. They have been practicing guerrilla trade warfare against us for 20 years, and we have sat passively by. And the U.S. housing bubble, like the housing bubbles in the Asian countries and the credit bubbles in Mexico, is the result of the inflow of foreign money to the United States. Foreign savings were displacing domestic savings. It was not that we needed foreign savings. We had a lot of foreign savings. It was that the inflow of foreign savings was the source of the crisis, and hence I would not agree that we have enabled each other. They took great advantage of us in terms of our ignorance or stupidity, and we have a massive housing crisis and now a massive fiscal crisis as a result of the implosion of that bubble.
Thanks, Bob. Ann, more comment?
Yeah, first off, well, several comments. I agree that credit binges have certainly been an important part of it. I think there were credit binges under fixed exchange rates too. I think, Bob, we are forgetting some of the crises, as for example the French franc in 1968, the pound crises later on, not to mention 49, some of the developing countries that had unbelievably disequilibrium crises and credit expansions earlier on, including, I think of Argentina, Finland, Turkey, many of the others, so that I think there were crises under fixed exchange rates too, and I agree that holding an exchange rate can lead to problems elsewhere in the system. John is absolutely right on that. That said, I also think that it was much more, there were real disturbances along with things with the four, or most of the four you mentioned. I think of the Asian crisis. Well, I think South Korea made the big mistake in opening up capital account when there's credit rationing domestically and when the banking system had not as yet been liberalized, and they opened up short term before they opened up long-term capital flows. And again, it was a series of policy mistakes that had very little to do with the exchange rate regime. Certainly the oil price increase of 1973 would have had far more disruptive effects on the world economy had there not been the move to floating rates right before it. And even then, the debt crisis in the 1980s was in response to the failure to adjust in the 1970s to the oil price increase. So I don't quite think that Harry or Milton Friedman or any of the others ever said that no matter how foolish domestic policies are, fixed floating exchange rates will make sure there's no lack of smoothness in the system. First off, these weren't really floating rates in many cases. Certainly the exchange rates in Asia were managed. The Japanese case was holding capital account closed and credit rationing until the 1980s and then loosening it up very quickly. And that had a great deal to do with the difficulties there in the 90s. So I guess I really don't see that one. I am, of course, well aware that when you have a country that can change its exchange rate when it's become uncompetitive, as for example Greece has, that makes the adjustment process much easier, and Greece faces much more of a need for internal devaluation than would otherwise be the case. But I would point out that there have been several very successful emergence from crises or avoidances crises where there has been relatively strong fiscal adjustment with none of the kinds of reactions that John was talking about. I have in mind Turkey, which in 2001, when I joined the fund, had a fiscal deficit equal to about 20% of GDP. It had inflation over 100%. The fiscal deficit was cut over a very short period of time to a primary surplus of 6.5%, which was virtually balanced budget within 4 years. And the Turkish growth rate was up above 6% during all that time. Growth rate accelerated precisely because there had been debt overhang and because this weighed on the financial system so much that the financial system did have to be restructured, but it wasn't the financial system's fault in a sense. Brazil in 2002 is another case where indeed they had to shift quite substantially to primary surplus and did so with accelerated growth. So I'm not totally convinced, depending on the situation. Countries where indeed the fiscal has been so bad, there can be room for adjustment the other way. So I'm a little bit less pessimistic in that regard, although I certainly think that the Greeks have a big problem of restoring competitiveness, so I don't want to argue with that.
Desmond?
Yeah, I just want to support a point that Anne made that, you can get huge misallocations and crises within a fixed exchange rate system. You've only got to look at Europe, that within a fixed exchange rate system, both Ireland and Spain had housing bubbles that were a multiple of those in the United States. So, to blame it on the exchange rate system, I think is wrong. I would say, though, that experience, in both round the whole periphery, I think that it's too easy to put all of the blame on Greece and say that Greece was profligate in its spending, that there was no way that that spending could take place if there weren't lenders in Germany and France who were plying them with the money. I think that to blame the U.S. housing bubble on exchange rates or the Chinese savings glut. I think that that is also, far too easy. I think that it was policy mistakes on the part of the Federal Reserve that really got us into the mess. The last point is I'm equally optimistic as Anne is that you can do fiscal adjustment on a big scale. I was involved with Sweden in 1992, where their deficits were of the order of Greece's. They had a banking crisis, the whole 9 yards. But what they did is they had the wisdom to get out of their currency peg and to allow the Swedish crown to depreciate by 30%. They had a huge export boom, so it allowed them to do the fiscal contraction without getting themselves into a downward spiral. And I suspect that that's true of the Turkish and the Brazilian cases that Anne alluded to. My only point is that within a fixed exchange rate system, when you've got imbalances on this size, both on the budget and on the balance of payments, there's no way that you can solve those with fiscal austerity without driving the economy totally into the ground.
John?
Yes, I certainly agree that with a relatively small open economy and a flexible currency, you can adjust. The fund did a nice study of that about a year ago and went through the successful cases. And one of the important points is that for Sweden and other small countries that successfully undertook a fiscal consolidation, they had the leeway of the currency, and of course the Greeks don't have that. I'm still intrigued by the idea of the U.S. housing crisis being due to the exchange rate or the relationship with China. I suppose, if you had a passive U.S. central bank with evidence of an asset bubble, with the currency wanting to depreciate, I suppose if the Fed just allowed currency outflows, that might have engineered the kind of stringency that would have preempted a bubble. I'd have to think about that a little more carefully. But in any case, the international monetary system and the attitude toward currencies is very much very evolutionary, very much undertaken on an ad hoc basis. And I think what we probably learned, and what we usually learn, and I think the point that Milton Friedman and others at Chicago were trying to make is that if you do something like peg a currency and then don't follow the rules, you'll get into trouble. And the litany of currency or crises that Bob has laid out so well are pretty much tied to that problem. And the richness of the history about these currency crises is testimony to the imagination and agility of finance ministers and central bankers, as are the words they apply before they're just about to undertake a devaluation.
Thank you. My read, if you can, I'm going to get to work, and I'm going to come back to Ann, and then I'm going to give Bob one more minute, given the balance in the panel. I just want to say that, yes, my read of financial history, John, is that it doesn't matter what you do. You still get into trouble from time to time. Ann.
How long it takes to get into trouble and how much trouble may make a difference. All I want to say, quite clearly, lots of things contributed to the housing bubble, but everything I know says that lower real interest rates and lower rates on mortgages certainly encourage more housing. Certainly the U.S. interest rate, given its fiscal stance, was lower than it would have been had the Chinese not wanted to incur a surplus on their current account. And certainly in that case there would have been more inflationary pressures than there were in the U.S., which again would have led to tighter monetary policy. That would not necessarily have prevented any housing boom. It almost certainly would not have, but it might surely have moderated it. In my judgment, the only question is how much. You could argue that this was major, you could argue it was minor, but certainly real interest rates were way too low, almost negative, during part of that period, and they could not have stayed there without much more difficulty had it not been for the availability of Chinese savings to partially close that particular gap. So I have no question but that contributed to it. I do have a question even in my own mind as to how important it was. I tend to think it was quite important. But I would grant you that part is arguable. That it was there, I don't think there's any question.
Bob, 2 minutes.
Thank you. I won't use all 2 But I want to come back to the normative case for floating exchange rates. And I said there were two elements to that case. One was we do not want distortions at the borders. Now we have, under the peg rate system, we had distortions at the borders. I remember a conference at Chicago, the Mendel-Swoboda conference, and I wrote a paper on introducing flexibility into the IMF system. And Gottfried scolded me politely because Gottfried did not want distortions at the border. So my first question for you is, given the changes in exchange rates, have the distortions at the borders between domestic prices and foreign prices been larger or smaller than they were under pegged rates? There's an easy answer to that question. The second point I would make is that, yes, we had a currency crisis in sterling. We had a currency crisis in the French francs. But to my knowledge, none of the currency crises under the pegged rate system was associated with the banking crises. And virtually all of the banking crises under the floating rate system have been associated with either a currency crisis or with a sharp decline in money inflows. The third point I would make is look at the variability in the ratio of current account balances to GDP under floating and under peg. It's been much larger under floating. The fourth point I would make is that under floating, we've had patterns of Ponzi finance. We have rushes of money into a country at a rate which is unsustainable. And we also have that, of course, with Greece. But it's much more intense under the floating rate system. And it's much more intense because the money flows into a country become self-justifying and lead to increases in asset prices, and that feeds back into itself. If only Milton were here.
Thank you all for a really stimulating set of presentations and responses. And now we're going to give all of you a chance to ask your questions. May I remind you of how we do this? There is where's my microphone here? Please wait for the microphone and then tell us your name and your affiliation, and then ask your question. The chair will allow statements that aren't questions up to a maximum of 15 seconds. I'm going to start on the left and move across this way, this gentleman right here.
Not necessarily a man of the left. Ernie Prieg, Manufacturers Alliance. This subject today was currency wars, which implies between governments and the existing today's monetary system, and some reference to China, U.S., and currency war. We got this Donald Trump syndrome. But what surprised me that throughout the whole hour plus, there was only one passing reference to Article 4 of the IMF, currency manipulation, which in my view could be considered the principal offensive weapon of currency war, and was fundamental to the shift to floating rates in 71. They rewrote Article 4, 77, 78, saying, just to quote it, members should not manipulate their currency to gain an unfair advantage in trade. Currency manipulation defined as protracted large-scale purchases. There have been $3 trillion of purchases in last China. So this is a big issue in terms of why, in my judgment, why the floating rate system has been failing in the last 10 years, because it's a gross violation of the currency manipulation obligation. I wonder whether anybody can comment on that.
May I take that? Let's, John.
Well, I would submit that this isn't a failure of the floating rate system. In other words, if the Chinese currency had been allowed to appreciate as markets were suggesting, then we would have had less problems. So it's a byproduct of not allowing the currency to float.
Bob?
U.S. and
I'm sorry, John.
Yeah, U.S. and China both have different monetary policies, and so the currency needs to float.
Bob?
Yes, well, I wonder how Milton Friedman would respond to your very acute observation. And I've asked myself that question. And so I think that Milton, Harry, Fritz, Gottfried, et al. Thought that these foreigners were good guys and would not intervene and undervalue their currencies, they had forgotten, Milton, etc., had forgotten the beggar-thy-neighbor slogan that Joan Robinson attributed it in the 1930s. And what we now have is essentially a repetition of the saying. The rules of the IMF, in part, were to prevent beggar-thy-neighbor policies. We got rid of the IMF, and we got rid of the ability to penalize countries that were beggaring thy neighbors. I hope you make that statement every day in every forum until the end of time.
Say something.
And now we're going to take two more quick comments, but then we're going to let the audience ask some more questions. I had Desmond first, Ann, and then we'll give you a minute or two.
I just say, it's kind of clear that China is manipulating its exchange rate by intervening, but I think that the matter is a little bit more complicated, in a world of floating exchange rates, because if you're looking at it from the Brazilians' perspective, if you've got a large country in Northern America that has its central bank expanding its balance sheet from $800 billion to $2.5 trillion, that has some impact on the currency between the United States dollar and the Brazilian real. So I don't think that this manipulation, in China it's a very clear case of manipulation, but we shouldn't get too worked up about that, because maybe the way in which we're running monetary policy has got something to do with the exchange rate in which we get a competitive edge. And, that is really what I was afraid of, is that is the world it looks like we're going to go to, when we've got all of the countries at the same time having to engage in fiscal consolidation in a recession. You're just going to get a competition on the printing presses, and that is going to lead to a very messy currency arrangement.
One more response, Ann.
Yeah, quickly. First off, there's been a lot of interesting work done recently in relatively recent economic history of international trade, the international monetary system in the 1930s, and I think most people would give Barry Eichengreen and Doug Irwin plaudits for the best work. Interestingly enough, they've gone back and they've looked at which countries had increased their trade barriers more during the Great Depression and which countries did not. The countries that had altered their exchange rates did not. The countries that tried to maintain their fixed exchange rates were the ones that raised their trade barriers, and it's sufficiently clear-cut. It's not, nothing's ever conclusive. You can always find something, but on the other hand, it's one of those pieces of evidence that is surprising in its strength, not that it's there, but its strength. And even in 2009, if you go through the GTAP and their list of which countries raised barriers during the last recession, there's some indication that the countries that were less allowing their exchange rates to move did so. And on China, I find the discussion of currency manipulation quite puzzling, in the sense that according to the definition that many people use, i.e. China trying to peg to the dollar, the Bretton Woods system was a currency manipulation system.
Thank you. I will go to the next. I had a question here, Jillian. Can you get this mic here? And then I'm going to take here and here next. Okay.
Gillian Garcia, ex-IMF. I would like to ask the panel what they would like to see the US government do going forward, and B, what it would like to see the international community do.
Okay, who wants to take that up? John?
Well, I do with respect to the currency regime, or?
Yes, and the international arrangements.
Well, I guess I'll just plunge in and say what should the U.S. government do with respect to the currency arrangements and its policies? I think it's, as far as its policies go, it's. I mean, this is a huge, broad question. It's pretty much done what can be done on the monetary side, and on the fiscal side, needs to undertake. I mean, it's almost a very trite to say it, but it needs to undertake some credible long-term consolidation on the fiscal front. There's very little will for that, it seems, domestically, since Congress, as we sit here, is now engaged in another fiscal stimulus discussion. But as far as the currency regime goes, I guess I would say do nothing. I don't really see that this is the time to try to impose a different currency system. We just have to, there were so many disequilibria, we have to deal with a very ad hoc system that we've got and try to repair some of the imbalances. I think the basic problem with the currency system, as a number of the panelists have pointed out, is that everybody wants a weaker currency because they all want to undertake fiscal consolidation, and that's a big degree of freedom, and everybody can't do it.
Desmond?
Yeah, I agree with John. You know, basically what you'd want the United States to do is to engage in some sort of addressing of its medium-term, long-run budget problem correctly. But I think that the reality is that within an international context, that requires coordination of policies. You know, what we've got is we've got a problem with the surplus countries not prepared to do what is needed to make room for those countries that have got imbalances to correct it. You know, and I'm seeing that most clearly, not forgetting about China for a moment, but why not let's talk about Germany. I think that what's going on in Europe just makes absolutely no sense, that there's no logical coherence to the fiscal compact that they're trying to do. If you're wanting Greece, Portugal, Ireland, Spain to reduce their current account deficits, what it means is that the other side, Germany, can't be increasing its current account surplus at the same time. They've got to be moving in the opposite direction, and there just seems to be no appetite for that, and that seems to me to have been the weakness both of the Bretton Woods system. You know, you had a problem with the surplus countries, and it's a problem right here, is that the surplus countries, there's an asymmetry of the pressures on the surplus countries to adjust. But if you don't get that, if you don't get them changing their mindset, then you've got a problem with global aggregate demand.
A quick intervention,
Well,
then we're going to take our next question.
I mean,
Okay, Bob. Just hang on. John, Bob.
Europe needs a scarce currency clause, but you can't have one with a currency system where all the rates are pegged.
Bob?
Yes, Julian, this is a great question. Some of you may have seen an article that John Cassidy had in the New Yorker on what would Keynes have done. Would Keynes have wanted to cut taxes or increase expenditures? We cannot have fiscal consolidation in a meaningful sense as long as we have a trade deficit of $700 billion. It's just that simple. We don't have the time to negotiate a new international system. I'm on the record as sort of saying, if we can't get an agreement bilaterally with the countries that have excessively large trade surpluses and are beggaring us, then we impose John Connolly type across-the-board tariffs on them until we get the trade imbalances down to a sustainable level. If we reduce the trade deficit by half, would be close to full employment, and we would have made a tremendous headway in reducing the fiscal deficit. We still need fiscal consolidation, but to attempt fiscal consolidation while we have this massive trade imbalance, this massive drain because foreigners are beggaring us, that is not very sensible.
Okay, Ann.
Yeah. The current account or the trade balance, whichever you want to talk in terms of, is the difference between national saving and national investment, public plus private. Reducing the fiscal deficit is reducing national dissaving, which is a form of reducing the current account deficit. In fact, it's hard to imagine how the U.S. could ever get back to anything like a more reasonable, sustainable position without something happening on the fiscal balance. Now, I could agree about the time phrasing of this, but not getting into some kind of medium-term prospect for it, it seems to me is sort of saying we're not going to get at the problem.
Okay, this is our next question, right? This lady up the aisle here, and then I'm going to come back here.
Hello. Hi, Krista Toomey, teaching at American University. I would like to go back to the Greyhound comment, because what I'm concerned about is that the Greyhounds are coming back around, but the track has changed, and people aren't recognizing this. Maybe that's because I come from a developing country, but I'm very concerned with some of the suggestions, not by your panel, you touched on them, by various members of the IMF about capital controls becoming the flavor again, and even maybe not a pure floating, but forms of managed floating, which for me are concerning because of the idea behind that, that somehow the government will be ahead of the market for a substantial period of time for them to actually work. And I think that things have changed to such a degree in the international market that both of these options are not feasible and the costs far outweigh the balances. And as such, I'm particularly concerned that this message filters down to developing countries making policy. I'm from Africa, where there's no scope for trying to even keep one step ahead of the game, either in trying to manage your exchange rate or impose a capital control at all.
Do you want to direct a question to the
yes,
panel
I
after that
apologize.
interesting comment?
So I would just love to find out what some other opinions on this were, or whether you think these two options are viable for developing countries with little government capacity.
Very quickly, I agree with you.
Other comments? Bert.
Thank you. Bert Ely, banking monetary policy consultant. We have heard a lot of remarks today about such things as credit crises and debt and excessive leverage and so forth. And I would agree with you that that seems to be a common thread through these crises and have also helped to feed things like the U.S. Housing bubble. But I have a public policy question for you. Given the fact that leverage shows up in all these crises, is it good public policy in the United States and perhaps in other countries too to basically have the Internal Revenue Code subsidize the cost of debt through the interest deduction for homeowners and for the deductibility of debt expense by businesses? I mean, it seems to me if leverage and debt are a problem, then why are we subsidizing it through the tax code?
Okay. Why are we subsidizing debt? And what should we do? John?
Yeah, stop. Yeah, I mean, that's another. I mean, I agree with Bert that the this obviously the stock of housing got to be too large in the U.S. because there's a huge implicit subsidy there, and so if you sort of combine a debt subsidy culture with a culture that wants to undervalue its currency, it suggests that there'll be a lot of capital flows from China to the U.S. That said, and going back to the
debt capital.
Yeah, capital. Yes, debt capital. We could go into that, but that said, I guess I was going back to the previous question. What should the U.S. do? And here again, if let's suppose that the U.S. behaves like Sweden did in the early '90s and pursues an aggressive fiscal consolidation and allows the dollar to depreciate rapidly, what will the rest of the world do?
Are you leaving that there, or
well,
are you going to tell us?
I suspect there would be substantial resistance to dollar depreciation.
Okay, thank you. Bob is waiting, then I'll get.
Bert, with respect, I might agree with you, but your point is largely irrelevant because it doesn't explain what was happening in Britain, Iceland, Ireland, and Spain in this round. It doesn't explain what was happening in the Asian countries and in Mexico in the early 1990s. It doesn't explain what was happening in the Nordic countries. In each of these cases, the source of the problem is excessive growth of credit, and it is not as if we changed the regulations at that time. We've had these interest rate subsidies, if you want, for a very long period. So what we need to do is to explain the timing. If I could just correct John Makin's last statement, we may have a fiscal consolidation, but we cannot control the foreign exchange value of the dollar as long as our friends and neighbors in Asia and other countries wish to maintain high tariffs and low values of their currencies. We're just too damn passive. We've been too damn passive, and I hope we can adopt my scheme to reduce large trade imbalances, and then we can have the fiscal consolidation.
Desmond.
Yeah, I just wanted to say two things. One, just in relation to Bert's question, that I think that if you do look at certain things like tax advantages, that is a way that you can influence whether or not you get a bubble developing, and I think that where our failure was is not a question as to how we were setting our interest rate, but it was a question that there were macro-prudential measures that you could have taken to prevent a bubble from occurring, and that's where I think that there's failure on the Federal Reserve's part, in that there was a lot of origination of mortgages by people who didn't have skin in the game, and that the whole system was rigged in a way. You could have raised loan-to-value ratios, you could have controlled it in that way. So I don't see that you've only got one instrument to deal with these bubbles. And what you're alluding to, might go in that direction. But to an earlier question, just in terms of capital controls, I think that, if you put yourself in the position of a country like Brazil, where you're getting a huge amount of capital coming in, driving the real up to ridiculous levels, then it opens up current account. If you don't do anything, what you're just doing is you're inviting a major crisis, as, for instance, Turkey is going to find out right now. If you let the current account deficit go happily to 10% of GDP, I don't know that you can just sit passively and watch it. So I've got some empathy for them wanting to do take some measures to try to, at least from a short-term point of view, control the currency. Or what you could do is, what many of these Asian countries do, is I don't see why you don't engage in a lot of exchange rate intervention to slow this thing down, because you're going to make money on the deal if your currency's so overvalued.
Excuse me. Just very quickly, in the case of Turkey and in the case of Brazil, what they need to do is tighten fiscal and loosen monetary policy. Both of them have the wrong mix, which is a significant part of the problem.
All right, we could have a lot of fun with each other, but we're going to let the next question be asked back here, please. And then I'll come up to you.
I'm Preston Nix. I'm a student at the University of Texas, so quite a long way away from here. And my question is, what do you see the relationship between currencies of developed nations and developing nations in the next 10 to 20 years, considering you have developed nations like Japan that has already lost 3 million workers due to population aging. You have Europe expecting to lose 100 million people in the next 40 years to demographic decline. And so then you might have stunted growth because of that. So, the baby boomer generation reaching the age where they'd save for retirement up to 20 years ago, which corresponds with Japan's stagnation, which is also where Europe is today. So if that becomes a trend, do you see currencies depreciating in the developed countries and then, appreciation in developing? Thank you.
Okay, somebody want to take that? Ann?
I can talk a little bit to that. Of course, the big question is what happens as to how you finance pensions and all that. This goes back to fiscal consolidation. And quite clearly, what happens to currencies is will be a result of other policies and not something independent of it. Quite clearly, there is a potential demographic dividend in some, but remember, China has the same demographics as a developed country in many regards, and is likely to start losing its labor force or declining labor force fairly quickly. India has more, but so far has labor laws that don't enable it to take advantage. So very much depends on what happens in the saving investment balance here, and then I insist goes back to public sector financing of its public obligations.
Okay, thank you. Got a question here, and then we'll come across this way. Yes, right here. Wait for the microphone, please.
I came from Philadelphia just to ask this.
Could you tell us who you are, please?
I'm Lana Young from U.S.-China Business Alliance Consultant. I would like to know, I read about a year ago there was an audit at the Federal Reserve System, about $14 trillion missing off the balance sheet. Does any of the panelists know what comes out of it?
Yeah.
We're talking about how many trillions aren't on the
14.
U.S. balance sheet.
I think this is came up in the campaign, and I think it refers to what they're doing is essentially accumulating U.S. Federal Reserve asset purchases without it's a gross figure, not a net figure. So if you add up all the asset purchases over a long period of time, they come up to be a large number. As I recall, when I was asked this question, I think somebody up in New Hampshire on National Public Radio went into this. And it's simply a confusion of not allowing for the fact that while they're buying things, they're also assets are also maturing and running off the balance sheet. So the short answer is that there isn't $14 trillion missing. It's simply the $14 trillion comes from counting gross flows instead of net flows.
Thank you. Got a question here.
Yes, Chris Bladowski from Manufacturers Alliance. I've got a question to Professor Aliber. Suppose we go with your conclusions from 1966, and I don't know how the debate ended and what the content of it was, but suppose we practically have to introduce the fixed exchange rates. There are two options. One, to have one currency for the whole world with some kind of a multinational central bank, which politically I think is infeasible, or we have national tenders fixed through some fixed peg. And the question is, how do you get the world together the way the U.S. got everybody together, just a handful of countries after 45, to do it with the reserve asset being the gold? How do you select the reserve asset, and how do you get the China, the Russia, the Gulf countries, which are the surplus ones, the Brazil, and then the remaining ones to make the adjustments to the reserve asset?
How long do I have, Mr. Chairman? Well, you've asked a key question. I've expressed my dissatisfaction with the current floating system. There's an absence of rules on the one hand that allows beggar-thy-neighbor policies, and there is the claims of the proponents have clearly not been fulfilled. They did not understand how currency markets operate, et cetera, and that's why we've had these massive imbalances. But now to the political, your question is really a political question, and the answer is, the wise-ass answer is you do it slowly. You first identify what you think the nature of the problem is, and then you try to find countries that agree with your analysis and the solution. And this gets back to the question I think that the lady from Africa asked. We're going to have to be sort of ad hoc. We need some sort of an arrangement which limits the volatility of cross-border flows. We've talked about exchange rates, but the large changes in exchange rates are really a reflection of the sudden changes in cross-border flows. This was clearly unanticipated by all of the proponents of floating exchange rates. All of their shocks were real. None of their shocks were monetary. Professor Wanicott's going to correct me in a minute. And then we're going to have to be sort of pragmatic and have, when imbalances become excessively large, then central banks are going to have to intervene. Let me just conclude with one brief observation. I've been a fan of Iceland, and I've identified the crisis, that it was forthcoming, et cetera, and wrote about it. But in retrospect, I've asked myself the question, and the Iceland crisis occurred at the day of the Lehman crisis, what was the date after which an Icelandic crisis was inevitable? And when I look at the imbalances in Iceland, I conclude that was sometime in midnight 2005, 3 years before the actual crisis occurred. The imbalances were just massive, absolutely massive. Current account deficit of 20% of GDP, financed in part by gangsters in Iceland, et cetera. Well, when we see large imbalances, then you and I will be the ad hoc referees and put on margin controls, ad hoc tariffs, et cetera, et cetera. We will point out that these flows are not sustainable. Thank you for the question.
Bob, at what point was the collapse of the American housing bubble inevitable?
Well, you know how I've answered that question in the past because I send you the things I've written, and I was writing in 2005, in the spring and summer of 2005, that we had a housing crisis and that the housing crisis would implode and we would have a recession and the financial institutions would come down. But just on this point, I made this a talk to the Hanover, New Hampshire Rotary Club in August of 2005. And a real estate agent came up to me afterward and she said, "Bob, you're late. Buyers are walking away from deals." I then began to look at the newspaper ads, both in our local papers and in the journal. Prices cut, seller motivated. We were having auctions in Florida in the summer, auctions of properties in foreclosure in the summer and fall of 2005. But somehow the officialdom in Washington did not wake up that there was a housing problem for another year and a half.
I remember the note you wrote to me about that at the time. Question here.
I'm Mark Brodsky, retired physicist and CEO. Only one of you, I think, had mentioned the word regulation once in the whole discussion. I think what Robert is saying and a lot of his things are really regulations. It seems to me a lot of these problems, going back to, say, the federal savings and loan crisis we had a couple decades ago, all have to do with insurance or implied insurance without regulation. Somehow this money flows, the people do these things, they originate mortgages without having anything at stake. This all has to do with some sort of insurance at the same time that there's no regulation. Anybody want to comment on that aspect?
Okay, Ann?
Yeah, well, the major part of the comment is that the savings and loan crisis came about because the savings and loan banks were constrained in the interest rate they could pay to a very low level, and then when the interest rate went up on what they had to borrow to finance and cover between their long-term, short-term mediation, they couldn't cover it. Now, so in effect, you're right about regulation, but in this case, it was bad regulation that led to much of the problem. It was not. It was simply a matter of having had very low interest rates, and then when they went up, and these things have their mortgage payments coming in at 3% and their borrowing rate at 6%, of course, they had a big problem.
Okay. Next question.
But I would only point out that the source of that problem was in the 1970s. And it was in the rapid growth of credit and in the surge in interest rates, rapid growth of credit, and then the change in policy that came about in October 1979 when interest rates surged. If we had had far less of a surge in the credit growth in the 1970s, the savings and loans, the banks in the Midwest, in the grain states, the banks in Texas would have been far less vulnerable to the whipsaw that came out of Washington.
Thank you. Another question? Well, okay, right back here.
Yes, good afternoon. My name is Adam Bryant. I'm with one of the consulting firms. And this kind of builds on the last question. During your presentation, you said that the financial system needs regulation to ensure money goes to the most effective places and ensures savings. And I was wondering if you can give us examples of that better regulation that you've mentioned twice now.
Well, quite clearly, higher capital requirements are one thing, and that I think is pretty much agreed on. Quite clearly, you can talk about contingent convertible equities, which bonds which would go into equities if there were difficulties, which strikes me as the least costly of the ideas that hasn't been adopted. You can think in terms of a higher interest charge for bigger banks, but that would have to be done internationally, or you're penalizing your own banks too much. There are a number of those things that can be done. There's a lot of debate, as you know, about whether the separation of investment banking from commercial banking now has been with the Volcker rule and so on is wise or not. I just don't have I haven't formed a firm opinion on that. I can argue either side of that particular case. But there are a number of things going on. But that kind of regulation, which improves the incentives for banks to be more careful in terms of their own risk-reward evaluation, makes sense. There are other kinds of regulation, as for example the low interest rates on deposits, that make no sense. So this is what I was trying to say about the difference between regulation that would improve the functioning of the system versus the other. There is always a problem when a bank gets into trouble because there is then the incentive, as it is used in the literature, the gambling for resurrection. You take on high-risk things and charge high interest rates. Since you're already in trouble and you've already lost your equity, if that pays off, you're back in business, and if it doesn't, you're no worse off because you've already lost it all. And that's the kind of thing that makes finance different from other things. Inherently, finance is taking something sure now and going into an uncertain future, and banks, in addition, have the intermediation between short-term and long-term. So inevitably, it's a difficult field, but it's part of a backing of the economy. If I can just say one more thing, I don't disagree with Bob on his credit at all. I agree. But I don't think that credit expansion is entirely exogenous. I think it's endogenous to the system.
Yes, thank you. Thank you. Brussels has said that European banks need more capital. This is one of the most stupid policies that has ever come out of Brussels at this time. It's like telling in Washington, forgive me, that we need to get rid of Fannie and Freddie by Friday, right? We may need to want to get rid of them, but this is a bad time to do it. I have not written about the optimal amount of capital for a bank, but I want banks to have very little capital. I want them to work on slim margins, and that is what I'd call a financial system. And the smaller the margins, the closer they are to the edge, and the more cautious they will be. This idea that there is safety in more capital is one that we're going to disagree about.
This may take us very far from the international exchange rate regime, but I will, speaking of banks, since we've gotten there, mention that between 1900 and 2000, that's 100 years, a banking crisis started somewhere in 54 of the 100 years. I guess that supports some of our views of these things. And it seems to me, Bob, that one of the reasons they do is because of the smallness of the capital, not because of the bigness. But we'll debate it another day. Any other questions? You've asked some excellent ones. You're a great audience. If not, thank you. Oh, I'm sorry. I missed it. I'm sorry. Yes, come here.
Yeah, remarkably little has been said about the euro. And I guess...
Would you you'd identify yourself for us, please?
I'm Paul Wanacott, University of Maryland. Let me ask you about something which concerns me very much, and that is, the question is, what do they do now, looking ahead? And they say what we need now is some sort of fiscal federalism or fiscal arrangements. And how are they going to do that? They're going to go back essentially to Maastricht and say, this time we mean it to show we mean it. We're going to have the courts enforce it. If you said in the United States we're going to have fiscal policy run by the Supreme Court, I don't know how many people would hurt themselves laughing. But that's the thing that bothers me, is that then the next step is to actually have sort of, if you have fiscal federalism, you got to have real political federalism. Are they going to be driven by one crisis after another towards a federal system, and then wake up and say, we didn't want that, we were dragged into it by the elites and the crises? I mean, you know, are they really setting themselves up for a tremendous political mess?
All right, who wants to take that up, the politics of European federalism? John.
Well, I agree with Paul that it is the European monetary system is a triumph of politics over economics for the time. And what's remarkable is how much pressure the poorly designed system has put on the politicians. And I think it comes down to how big a check are the Germans willing? How big a check will the Germans write? If it's big enough, then maybe they can get by. If it's not, then Greece has to leave the system, and then probably Portugal. And it's painful to watch, but I think that's what we're watching now. I did want to add one other thing. I hope that I wouldn't want to end up with the conclusion that what we need is a world central bank. The world is not an optimal currency area. Even Europe is not an optimal currency area. I think we need some realistic divisions among currency areas, and we also need to allow for some continued flexibility of exchange rates, notwithstanding the efforts of many of the authorities to frustrate the adjustments that they would affect. It's interesting. I think the panel, perhaps, or people over time look at the same set of events, and one is led strongly to the conclusion that we need floating rates or more exchange rate flexibility. That's where I end up, and I think Bob ends up saying, well, what we need is less exchange rate flexibility, looking at the same set of facts. So probably the discussion will continue, will go on.
We hope so. I'm going to allow Desmond, you have a comment still?
Well, just on Paul's question,
okay.
You know, I think that this is all very hypothetical. I think that what they're doing is they're setting themselves up for failure because they're only going to move towards a fiscal union in the end. You know, essentially what they're trying to do is they're trying to get the countries in the periphery to establish a track record that they can live with the balanced budgets. So what they're doing is they're wanting to have externally monitored adjustment programs that will get them to the balanced budget in 3 or 4 years' time, but that's never going to happen because the basic problem is if you can't do the current amount of fiscal adjustment in a fixed exchange rate system, how much less so are you going to be able to get to a balanced budget? So I think that this thing will blow up long before you get into the practicalities of how you're going to police it any better than you did the Stability and Growth Pact, which fell apart as soon as Germany and France exceeded the limits in 2003, 2004.
Bob had a comment. Last comment from Bob.
Thank you. Thank you. Europe has been a great success story, just a great writing a constitution over the last 50 or 60 years. Contrast the Europe of the last 60 or 70 years with the previous 60 or 70 years. The biggest struggle, armed conflict in Europe in the last 60 years has been Bosnia. We should be patient as Europe writes its constitution. There will be setbacks. And this setback, the politicians have been reluctant to position Greece so that Greece leaves. It is incomprehensible that such a small country, 2% of GDP, even with Portugal, 4%, can throw this grand experiment into turmoil.
And we'll give you the very last word if you like it.
Okay, thanks. In the case of Greece, the problem from the crisis started has been that Greek debt is unsustainable, and there is no solution that doesn't entail Greece's budget getting back on track so that going forward, whatever they do is sustainable, but meanwhile a sufficient reduction in debt, and both of those in turn retake growth, and Greece has managed to strangle its economy in microeconomic regulations to a degree that we can't even begin to imagine. And all three have to be addressed, and the Europeans seem to take it one at a time, and they put their finger in the dike there, and then they discover it's leaking over here, they forget this one, go there, and so far as I can see, they are still, to a fair degree, going around in circles, and until they get a comprehensive thing and are realistic, they're going to get nowhere, and the fiscal federalism talk is just that.
Ladies and gentlemen, thank you very much for being with us, and let's show our appreciation for a truly outstanding panel.